South Indian Bank reported about a 13.9% year-on-year dip in the company's profits. The net interest income is up 2%, while the other income has fallen by 7% QOQ. The asset quality has declined, with gross NPAs coming in at 4.5%, which compares with 4.74%. We have with us PR Seshadri, Managing Director and CEO of South Indian Bank. Sir, thank you very much for joining in. First, if you could give us an indication how FY25 is likely to pan out for you. Your gross advances last year grew at 11.5%, with corporate segment seeing pretty smart growth of 37%, and the gold loan portfolio too growing a little faster. What can you guide for FY25 in terms of advances, deposits, and even the asset quality?
Thank you very much for having me on the show. Greatly appreciate it. FY25, our outlook is that on an aggregated basis, we'll continue to grow the way we've grown last year. But the mix will change, or at least that's what we're intending to do. We're intending to granularize the mix. We want to increase retail as well as MSME contribution onto the book. But in aggregate, the total growth rate will remain similar to what we have at this point in time.
So low double digits, 10 to 12% advances growth?
Yes.
Okay, and what will the contribution?
Early teens. Yes.
Low double digit, early teens will be the growth for the company. And you said you want to increase the contribution from retail and MSME. What does it stand at now together, and how much will it go up by, and how will it change your net interest margins then?
So right now it's about 32,000 crores out of our 80,000 crores of assets. So roughly about 40%. We are hoping to get that up to about 45%. Last quarter was a particularly good quarter for us from a net interest margin point of view. We went up 19 basis points from 3.19% to 3.38%. We want to continue that, and in an 18-month time horizon, take it up to approximately 350 basis points. At least that's the directional number that we are aiming to get to.
Mr. Seshadri, the increase you said, that is in the share of these segments, MSME and retail, right?
No, I'm talking about the overall aggregated NIM. So we want
the NIM.
Increase...
Okay, so you're hoping to expand NIM by almost 300 basis points.
No. I'm sorry if I was not entirely accurate in what I was trying to say. Our current NIM for the last quarter was about 3.38%.
Right.
The prior quarter was 3.19%. We want to take that up to about 3.5%. So another 10, 12 basis points increase. And that we want to achieve by changing the asset mix. Right now, approximately 40% of our assets are corporate. We want to take up retail and MSME from our current 30%, approximately 40% zone to about 45%, and bring the corporate down a touch. And that in turn should help us take NIMs up to that level.
Got it. Yeah, suddenly, so instead of 3.5%, I heard increase by 350 basis points, and that's why I kind of moved to the edge of my seat. No worries, sir. Absolutely. So, just to talk about this, since you're looking to shore up the retail book, what's the feedback you're getting right now? Your asset quality is quite pristine. There's been no issues over there. We all know the RBI stance on unsecured lending. So, what are the trends that you're seeing on the retail side? Within retail, what segment will you target? And a word on asset quality as well, whether you're hopeful of maintaining it at current levels, the GNPA level?
Yes, our gross and net NPA numbers have been declining for the last couple of years. We don't think that trend will change anytime soon. With a bit of luck, we should continue to see that trend continuing, and we are hopeful that we'll be gross NPA at the end of this year. We are hoping that it'll be closer to 4 as opposed to 4.5 that you can see now. And the net NPA number should be closer to 1 as opposed to 1.46 that you're seeing now. That's the directional aim that we have. With respect to the retail portfolio that we currently have, we have a very small unsecured book. We have a personal loan book, which is roughly about 3% of our total balance sheet. And that is targeted 90% to our own existing account holders. And that has been performing very well. And we think that there is reasonable room for growth there as well. And we have a credit card portfolio, which is also approximately 2% of our total balance sheet. So retail unsecured is a very small component of our total aggregated balance sheet. And we think that there is room to grow that at this point.
Okay. Just one more, guidance if you could share on the deposit front and even on CASA. What is the number that you're looking at for FY25?
So our CASA balances last quarter we ended at about 32%. The good news was that our current account balances grew year on year on an end of period basis, almost 20%. So current accounts, we had a good end to the year. Last quarter four, current account acquisitions increased fourfold. So we did what we did in the first 3 quarters in the last quarter alone. So we think that we have a reasonable product mix. We think that our engagement with our customers are paying off. We think that the 10 to 12% growth in deposits should not be a problem at keeping costs of deposits low. So our cost of deposits, as you can see in our investor deck, are comparable to some of the much larger institutions in the country, and that gives us an advantage from a P&L standpoint.